In this session, I'm primarily going to look at the different kinds of properties associated with the stock options specifically, right? So, in this, the prime things which I am looking at covering is the major factors that will affect or impact the option prices. So the option premium, when I say option price, it is more of an option premium. What are the various elements associated with the stock which can impact the option premiums? So we would be discussing different kinds of factors that could impact the option pricing, and the various assumptions under which the valuation model for options typically goes with. And we are talking about in what way I determine the upper and the lower boundaries. What is the mechanism associated with the upper and the lower boundaries associated with option prices? How do I really find out the upper and the lower bounds associated with the call option and put option premiums? Then the most important aspect, which we call as put call parity. I would be discussing or spending some time in terms of making you understand the clear cut importance of put call parity relationship, and uh, what does early exercise mean, especially with respect to an American call option. Is there any kind of a benefit that is associated with an early exercise, especially in case of a stock? Any benefit associated, or how do I really look at early exercise on a stock of both call option as well as the put option? Is there any kind of a benefit in case of early exercise of a call option or early exercise of a put option? How do I typically evaluate the early exercises, means the American options? And finally, I'm going to look at in case there are dividends, how do I consider the same early exercise kind of a scenario? So these are the different dimensions I'm going to bring out in this particular session. So with that as a base, the first part I'm going to start off with are the various factors that are impacting the option prices. Generally, it is felt that there are six major factors that would impact the option price. One is the current stock price. Then we talk about the strike price of the option. Then we talk about the risk-free rate of return. Then bringing in the time to expiration. And we are looking at the volatility of the underlying stock. And we are also looking at the dividends. These are the six major factors which we look at, and probably associate them with the call option as well as put option. So how each of these factors is going to impact the call option versus the put option. That's one thing which we are typically seeing. Now let's go by step by step. We know in case of a call option, the gain is going to be much higher. The party with a call option is going to exercise the option if the stock price is greater than the exercise price. If the stock price is greater than the exercise price or the strike price, the party is going to exercise the call option. So if the stock price is going much higher than the strike price, the chances of exercising the call option are increasing, which means the value of the call option is going to be increased. So from that dimension, what I can very well say is, as the stock price is increasing, now all these we look at it with respect to increase. For decrease, I can take it the other way. So if the stock price is increasing, the chances that a call option is going to be exercised is increasing. So which means the worth of the call option is increasing. The same is the case with the strike price. If the strike price is increasing, then the chances of exercising the call, which is buying at the strike price, the person may not be buying it at the strike price because the strike price itself is much higher. So as the strike price is increasing, the chances of exercising the call option will decrease, which means the value of the call option is actually going down. So if the stock price is higher and the strike price is lesser, then the chances of the exercise of the option are typically going up. So the value of the call option will be higher in this case. And obviously, in case of put, the the buyer of the put option is typically having a gain when the strike price is greater than the stock price. So as the strike price increases, the put is becoming more and more valuable, or even as the stock price decreases, the put is becoming more and more valuable. So if the stock price is increasing, the put will go less valuable, so its value is going down. Whereas if the strike price is increasing, the put is becoming more and more valuable because I can sell it at a strike price which is at a higher price. So the chances of exercising the option are going up in this case. So the put option value is actually increasing in this case. Similarly, now when we are looking at, let's say, time to expiration, and with respect to both call option as well as the put option, we see that as the time to maturity is increasing, if there is a lot of time from today till the expiry date, and let's say I am considering an American option, so the exercise can happen any time from all these days. On all these days, the exercise can happen. So on any one of the days, if the stock price is going more than the strike price, the person who has gone for a call option, he can exercise it. Similarly, the person who has gone for a put option also has all these days where the stock price can go lesser than the strike price drastically. So the number of options that are available, number of opportunities that are available will be higher in case the expiration date is much longer compared to the expiration date being much shorter. Because all the opportunity, let's say we have two options, one is expiring on this day, one is expiring on this day. Because it's an American option, I can talk about the person who is exercising on this day. He has the chance to exercise the option on any of these days. So it includes these opportunities plus something more, means the value is much higher. So what we see is, in case of American option, definitely an increase in the time to expiration is going to increase the value of the call option as well as the put option. But in case of European, it's going to be a slightly different scenario, especially during this period when there is a large dividend that is expected to come. Only in that case, when there is a large dividend that is expected to be declared during this period, because of the dividend, the stock price is going to fall drastically. So stock price falling, the chances of exercising the call option will actually go down. So that's one of the prime reasons. Though the time duration is much higher, opportunities are much higher, Because of the dividend during this period, if the stock price typically goes down, the chances of exercising the option will go worse. So only in case of large dividend that is declared between the two period, I find that with the increase in the time to expiration, the value of the call option will go down and the put is becoming more and more beneficial. But otherwise, in normal scenarios, when even in case of a European call option, if there are no dividends that are expected within this two time period, between the short and the long time period, then still with the date of expiration, the price associated with the call option is going to be higher, and the price associated with the put also is going to be higher itself. Now, the next dimension is the volatility. Generally, whenever we associate the word volatility, it is more to do with the uncertainty in the movement of the stock price. Uncertainty associated with the movement of the stock price. So, the moment when we are looking at the fluctuation being higher, from this particular price, probably I see that the stock can go either here or here. From a shareholder's perspective, from a equity investor or a stock holder's perspective, probably the kind of gain which he is expecting is compensating the loss that he could expect. So there is a kind of an offsetting behavior in this case. But when we are talking about a call option, so if the stock price goes something like this, the benefit is much higher for a call option investor, whereas if it goes down, the loss is limited. He will not exercise the option, so his loss is only limited to the typical premium that he has paid. Same is the case with the put option. If the stock price goes something like this, he will not exercise the put option, so it is a limited loss. But if the stock price is going down like this, he is going to get a good gain. So overall, it is looking like the benefit, if the volatility is higher, the scope to make a profit is increasing, but the downside is getting limited. So overall, there is an additional benefit that is coming up if the volatility is going to be much higher. So from that dimension, what we say is, as the volatility of the stock is increasing, I see that the call option as well as put option, both of them are becoming more and more valuable. So their prices are going to increase with the volatility quite comfortably. And when I have to talk with the risk-free rate of return, generally when the interest rates increase, the risk-free rate increases. What we generally say is, because the risk-free rate is increasing, the return that is expected even on the risky securities like the stocks is expected to go up. And because the return that is expected from these stocks is typically planned to go up, the stock price is expected to typically go up. And if the stock price goes up, we have already seen that the call option premium is going to increase in value, but the put option premium is going to decrease in value. But on the other side, in the reality, what has been observed is, if at all I see that the risk-free rate is going up, it is observed that the stock price generally tends to fall. And if that is the case, it may have to behave in the other direction also. But what is generally observed is keeping the other things constant, not trying to fiddle with the stock price, keeping the other things constant means if I am looking at only the risk-free rate in isolation, I see that an increase in the risk-free rate is going to increase the value of the call option but decrease the value of the put option. But if I take this as well as this together, an increase in the risk-free rate generally tries towards the decrease in the stock price, means overall call can go down, and the value of the put can typically go up. So whatever we are showcasing as a part of the relationships here are primarily when I am looking at no other factor changing. It's only that particular factor is changing with others remaining more or less constant. Now, when it comes to dividend, based on the kind of a dividend the company has declared, the stock price is going to fall. So more and more dividends declared by the company, more and more fall in the stock price. And if the stock price is expected to fall, probably the chance that the call option would be exercised will go down. So the call option is becoming less and lesser valuable. So the value of the call option or the call premiums are typically going down, whereas it acts as a good news in case of a put option. So that's the reason you'll find the put option premiums typically go up. So we have to be very much comfortable in terms of understanding this particular impact of various factors on the option prices, right? So that appropriate strategies can be built quite comfortably, right? Now, going forward in terms of assessing the value of the options, some of the assumptions that are being taken up in terms of assessing the boundaries of the prices doing the valuation, just like the way we have planned out in our futures market, where at least a few large players, for them there are no transaction costs. The whatever the profits that they have generated, all of the profits that have come out of the trading, the tax rates are going to be more or less similar. The borrowing and lending is happening in unlimited quantities at the risk-free rate itself, which is slightly away from reality, but these are the assumptions under which all these derivations are typically coming up. The arbitrage opportunities, even if they typically crop up at any point in time, they are utilized immediately because all these large market participants, they have that sufficient amount of skills to identify the arbitrage opportunities and take advantage of them, which means they disappear very clearly, very quickly, and that is where we can even make an assumption that no such opportunities exist as a part of our derivations. So in this case, we always tend to use notations wise. We call S naught as the current strike price, ST as the stock price, current stock price, ST at the stock price at the time of expiration of the option. We generally use K as the strike price, right? R we use it as the nominal risk-free rate of return. We don't take it as real, nominal. It includes the inflationary impact. Then we are also, as a part of the terminology, the capital T is being used to understand the time to expiration of the option, and capital C denotes the price of the price or the value of American. Capital letters denote American options. Capital C for American call, capital P for American put, the small c for America, European call, and a small p for European put kind of options. So this kind of notation will help us in deriving some important relationships relating to the upper and the lower bounds for the option prices, getting into the early exercises, understanding the call put parity relationship, and even further at a later point in terms of designing the strategies for getting into the various option tradings, right? Now we will get into understanding or computing the upper and the lower boundaries associated with both call option and put option, and even American and European. So American and European call and put, I want to find out what should be the upper boundary and what should be the lower boundary associated with the premiums for these options. All right. Now let's get into looking at this lower and upper boundaries. So simple way to start off. First, let's get into the upper boundaries. Now, with respect to the call option, we simply talked about that it's a right to buy the asset for a certain fixed price, for a predetermined price in future, at a future date. Now, what we are simply saying is, I am buying an option to buy a share. So, the option price cannot be greater than the share price at all. If the option price is greater than the share price, probably I could have bought the share itself. Why the option? So, what we simply say is the option price, whether it is an American call option or a European call option, the option price, small c, is denoted by European. So this should be lesser than or equal to the current stock price, because I could very well buy the share itself rather than buying the option. Similarly, for an American option, capital C, also it should be less than or equal to the current stock price, which means the maximum boundary, the upper boundary with respect to the call option, is the stock price itself. If at all, at any point the call option is exceeding the stock price, then probably a simple arbitrage opportunity can be created, wherein the person will buy the stock in the current market and sell the call option, because the selling of the call option is receiving a premium which is more than the price of the stock itself. So a definite arbitrage opportunity can be created in case the option price exceeds the stock price. Similarly, when I look at with respect to the put option, it's a right to sell, right? It's a right to sell one share at a strike price K. So even if now if I consider the worst case scenario, even if the stock price goes to zero, the minimum the stock price can fall is zero, in which case the loss that is possible, or the gain for the party at the max, is going to be K itself, which means the loss to the other party cannot exceed K. So the price of the put option, whether we are talking of American or European, it has to be lesser than the strike price itself. So the put options, the maximum boundary, upper boundary for a put option is the strike price itself. Whereas an American option can be exercised any time before the maturity, which means immediately also it can be exercised. If it is exercised immediately, then the price of the put option can be K itself, cannot be more than K. But in case of European, the exercise will happen on the expiry date. So on the expiry date, the maximum benefit that one party can get is K. The present value of the benefit is going to be K e power minus RT. So at the max, the put option, especially in case of European, the put option cannot be more than K into e power minus RT. Whereas in case of American option, because the exercise can happen even immediately also, I cannot consider the present value of K. I am taking the K as it is. So if at all any of this rule is violating, again the same. If P is greater than this, probably I could have written the put option, write a put option, and whatever the proceeds I have got, whatever because of the writing, whatever is the premium that I have received, I would be investing it at the risk-free rate of return itself. That's a kind of arbitrage opportunity that is getting generated out of the process. So just to summarize upper bounds wise, first let me focus more on upper bounds alone. Upper bounds wise, we are simply saying that for an European call, European put, American call, American call, American put. For the call options, the upper bound is the spot price itself, the stock price itself, whereas in case of European put, the upper bound is KE per minus RT. For an American put, the upper bound is going to be K itself. Right? Now the other dimension that I am looking at is the lower bound. In case of European call, we are saying the lower boundary cannot be less than S naught minus KE power minus RT. It should be, the lower boundary is definitely S naught, the current stock price, minus the present value of the strike price. The spot price, which is the stock price, minus the present value of the strike price. That is what will go as the lower boundary. And in case of European put, it goes the other way. In case of European put, the minimum value for the put option is definitely KE per minus RT minus S naught. For that, a simple way that we can work out. Okay, in case of, to just understand this European call, the minimum value for it, we'll talk about two different portfolios, A and B. A is a combination of one call option, which is European call, plus a cash equal to KE power minus RT. A call to buy a security at K after T period. Whereas in case of B, I'm simply putting it as one share. Right? I want to evaluate these two portfolios A and B. Now, I have a cash which is equivalent to KE power minus RT today. So, I am investing that KE power minus RT at R rate of interest per T period. So, at the end of T period, this amount is going to become K. Now, I have a call option to purchase a share at K at T period. So, if the stock price at that point is less than K, if the stock price at that point is less than K, I would have bought the share at the current stock price itself. I would not have exercised the call option. If the stock price at that point is less than K, I am expiring the call option. So the portfolio, I will not buy this at all. I will not buy the share. So whatever the amount that I am left with at that point is going to be K. And suppose the stock price at that point was greater than K, then I am able to buy the share at K, and I have K as a money. I am able to buy the share at K whose worth is ST. So the value of the portfolio A at that point is the maximum of either ST or K. If ST is greater than K, I am buying it at K, but its worth is ST. If ST is less than K, I am expiring it, so my worth is K. So the value of my portfolio at that point is a maximum of ST or K if I am going with portfolio A. And with portfolio B, now that I am having one share, Whatever is the value at that point, its value is going to be ST itself. So what I am seeing is the portfolio A is at least as worth as ST. It is more than ST itself. It could be more than ST in some cases where it is K. So definitely I can write it as call option plus K e power minus RT is definitely greater than or equal to the S naught. So obviously it is coming out as C is greater than or equal to S naught minus K e power minus RT. That's the logic that comes out saying that the minimum value of the European call option is going to be S naught minus K e power minus RT. The same logic gets worked out in case of European put also, wherein I am considering one portfolio C with one put option to sell the share at particular price K on the expiration date, and I am having one share which I can sell. Whereas another portfolio D which is consisting of a cash equal to KE power minus RT. Now what we are saying is, look at the portfolio C now. If on that day, if on the expiration date, the spot price is less than K, right? The spot price is less than K, I am going to sell that share at K. So I am going to sell that share at K, which means I am exercising the put option and I am getting an amount which is equivalent to K. My worth of the portfolio C is K. And in case the stock price at that point was greater than K, I will expire the put option. So I am having a share still with me. So if I am having the share still with me, the worth of that share is ST, whatever is the value at that particular point. So the value of my portfolio at any point in time is either K or ST, whichever is greater. Whereas this particular D, if I am investing it at the risk-free rate of return, its value is going to be K itself at the max. So my portfolio C, which is a put option plus one share, is definitely greater than or equal to K e power minus RT, which means the share is definitely greater than or equal to put option, the price of the put option is greater than or equal to K e power minus RT minus S naught. So this is what will bring me the lower boundaries of these kind of options. Right, the put option should be definitely the European put option. The minimum boundary is K e power minus RT minus S naught, whereas European call option, the minimum boundary is S naught minus K e power minus RT. That is one relationship which we have understood in this process. Then the next is the most important relationship that helps us in pricing the options, which is put call parity. Now if we remember in the earlier discussion, we talked about portfolio A, which consisted of one call option plus a cash equal to KE power minus RT, which is going to give me a value equivalent to the maximum of either ST or K on the expiration date. Similarly, portfolio C, where we talked about having a put option plus a share, even this is giving me a value of S maximum of ST or K on the expiration date. So basically these two are carrying a similar kind of a value on the expiration date. So this is what is a simple relationship that is getting. So because on the expiration date, if their values are the same, their present values also should be equal. And that is where we derive C minus P is S minus K e power minus RT. This particular relationship which is existing between the price of the call option and the price of the put option is what we call as put call parity. So what we can very well look at using this expression is probably I can construct a call using this formula P plus S minus K e power minus RT, which means I can construct a call option without a call option. So basically having a combinations with 3 out of these 4, a call option, a put option, a stock price, a stock, underlying stock and cash. Using these 4, I should be able to create one in terms of the other 3. That is what we call as creating synthetic positions. So a synthetic call is nothing but a long put plus a long stock plus a short position in cash. So this is our short position in a bond, which risk-free bond. Probably I can call it as a cash or a risk-free bond. So this is going to create a kind of a scenario which is equivalent to that of a call option. Now that is where we can use this kind of a relationship to understand some kind of mispricings and take advantage and create arbitrage opportunities accordingly. And this call put parity generally holds only for European options. In case of American options, I cannot talk about this call put parity, but to some extent people have created saying S naught minus K is less than or equal to the call minus put, which is less than or equal to S naught minus K e per minus RT. So instead of directly you are talking of call minus put being equal to S naught minus K e per minus RT, it is said that it lies between S naught minus K because it can be the option can be exercised immediately. So the present value does not come into picture. So at least some kind of an approximation relationship comes out saying the call value minus the put value will definitely lie between S naught minus K and S naught minus K e per minus RT. That is one more way we can summarize the put call parity relationship between in case of American options. Now we really need to consider the next important aspect, which talks about the American options, because we still did not find out the lower bound with respect to American options. The lower boundaries right now I have found only for European options, wherein I said for call the lower boundary is S naught minus K e per minus RT, whereas for put I said it is K e per minus RT minus S naught. Right? Now let's look at the what happens to the same call put parity relation, or probably the lower boundaries with respect to American options. So where there is a possibility of early exercise. Now let's look at the call option separately and put option separately. Now what is the scenario associated with a call option? I can buy the stock at a particular price K at a future date, right? Now let's assume the person is looking at purchasing. Let's assume the scenario where the current stock price ST is much lesser than K. Then uh, 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 then there is nothing much to do. But if the stock price ST is greater than K, then what we are talking of is there is a possibility of exercising the option early. So probably let's take some numbers. The current stock price, let's say, is $50 and the strike price is $40. Now there is a possibility that I want to exercise this American option, saying that I want to buy this share at $40 a share. Now, if I buy the share at $40 and let's say I want to hold on to this share until the expiry of the option, then what is the need in buying the share right away? Probably we could have waited until the expiry and on that day we could have bought it at the same $40. What is the fun in buying the share early at $40? If at all I am looking forward to hold on to the share at least until the expiration period of the option. So there is, it is nowhere better than purchasing the share or exercising the option on the expiry date itself. And probably the other way to look at it is, I am actually losing out the interest on this $40 going with the time value. I am investing $40 today itself to purchase the share, whereas I could have invested the same 40 probably let's say after 1 month to purchase the same share. So there is no point in losing out on the interest for that small period, because there is no way. We are talking about this example where no dividends are being paid by a stock during the particular period. And okay, now it is 50 but the strike is 40, so that is where there was a temptation. Probably if I had waited for 1 more month, it might have been possible. At least a limited chance could have been there. At least a 1% chance could have been there that the stock price would have fallen below 40. Then I could have bought the share at 38 itself if I had waited until the last. So in summary, what I wanted to look at is, if at all the investor is having an opinion that he wants to hold on to the share until the end of the expiry period, until the end of the expiry period of that, until the end of the expiration date of the option, then there is no point in doing an early exercise if it is a non-dividend paying kind of a stock. So there is no point in doing an early exercise, which means in case of a call option, the American option is no way, there is no reason why an American call option needs to be exercised early compared to a European call option. Now, on the other side, let's say if the person is not interested in holding the share till the expiry, he just wants to buy the share and he wants to sell it off in the market. Then probably the transaction costs that are involved in buying the share and selling the share, the commissions that are involved in buying the share and selling the share are so high that it makes a lot of sense to sell the call option itself and offset the call option position itself and make a better profit. So in that case, if at all the interest is to sell off the share immediately without holding on to it, then it's as good as selling off the call option rather than exercising the existing option, buying the share and immediately selling it off. So this could have resulted in a much better strategy, which means in none of the cases there is any kind of an advantage in holding on in exercising the call option, especially in case of American call. There is no advantage that is coming out in exercising the call option earlier. So which means the worth wise, value wise, the American call option is in no way better than a European call option, which means the lower boundary associated with an American call option also is similar to that of an European call option, which goes with S naught minus K into e power minus RT. So there is never, probably it can be concluded that there cannot be any reason where I can optimally exercise the European call earlier, unless there is a dividend that is going to be declared in the next period, and the stock price is going to fall drastically. Unless that situation is there, if I am talking about a non-dividend paying kind of a stock, there is no reason why that call option needs to be exercised early. So just a quick summary wise, the two main problems that I am observing in case of earlier option is I am losing out on the interest because I am purchasing the stock at the same strike price much earlier, whereas I could have waited till the last and then purchased it at the same price. So the interest lost, or probably looking at it from time value of money perspective, there is a lost opportunity in that case. And the second is, as long as I am holding the call option, it's a kind of an insurance that it is providing to me against the falling prices. Right, as long as the price is lesser than the strike price, I could have purchased it at a much lesser price. But once I have exercised the option, that insurance opportunity is going off and I am exposed to more and more risk. So that is where we see that the lower boundary of an American call option at any point cannot be better off than the European call option. So that's the reason we are saying the minimum, the lower boundary of an American call option also goes similar to that of a European call option, which is S naught minus K e power minus RT. Similarly, if I am looking at put option, American put option, which is a right to sell the stock at a particular point for a strike price of K. Now, if there is an opportunity that is coming up, if at all the market price is greater than K at any point in time, then I could sell the stock at K. So, if I am selling it at K, I am getting the proceeds early. If I am able to sell it today itself, I am getting the K today itself, which could be invested. If I had waited till the last also, I would have got the same K. The only thing could have been, either I could have sold it at a much lesser price, or at the max I could have sold it at K only. So if I am selling it at K, waiting after 1 month, I am losing out on the interest. So if there is a possibility to sell the stock at K much early, better exercise it, because you will get the proceeds early and you are making an immediate gain, and this immediate gain can quite comfortably be exercised and invested at a risk-free rate of return, which can generate a better return for you. As long as R is positive, risk-free rate of return is positive, you are going to generate a better return on that particular option. There is no way, there is no disadvantage that is coming in the process at all. There is no point in waiting. The moment the stock price has fallen below K, you are exercising the option because you could very well sell it at K. The moment the stock price is falling below K, you are exercising the option because you are able to sell it at K, and selling it at K, you are going to get your proceeds immediately, and you are going to invest it, which would give you a better return rather than holding on till the expiry and then selling it at K. So that is one of the prime reasons we see that the value of a put option, at least in some cases, because of the early exercise, is much better off compared to the corresponding European put option. So that's the reason we simply put out the price of the American put option is something like this. In case of European put option, we said the price should be greater than or equal to KE per minus RT minus S naught. Whereas in case of European, I can do an early exercise quite comfortably, which means the minimum price is K minus S naught, because I could have exercised the put option immediately and got a benefit. So to summarize, it's always optimal to exercise the American put option earlier compared to American put. I could exercise earlier if the stock price is going much below K. But if in case of American call, even if the stock price is going much above K, there is no point in exercising the American call option earlier. That's one kind of a logic which we need to be comfortable with. And the one more dimension that I'm more interested in looking at is what if the dividends are declared? Simple logic for all kinds of relations. Call put parity. Initially, when there was no dividend, we said call put parity is C minus P equal to S naught minus KE per minus RT. The simple logic now I'll say is if dividends are declared, where D is the present value of the future dividends during the year. If I know what are the dividends, you adjust the spot price by the present value of the dividends, which means C minus P will go as S naught minus D minus KE per minus RT. This is what is the call put parity relationship that is going to come out. And even earlier when I talked about the minimum lower boundaries of C, we said it should be greater than S naught minus KE per minus RT. Now from S naught you subtract the present value of the dividends. We said earlier P should be greater than KE per minus RT minus S naught. So you do it as minus of S naught minus D. S naught now is S naught minus D, which is the present value of the dividend. So the present value, so the put option should be worth minimum more than KE per minus RT minus S naught plus D. And similarly, in case of American call, we said the call put parity is more lying between S naught minus K to S naught minus KE per minus RT. So here also you subtract the present value of the dividends from both sides and say this is the range in which the call put parity relationship will be lying in case of American call and put options. So all these things can quite similarly be addressed, especially if there are dividend. Subtract the present value of the dividend from the spot price, adjust the current stock price by subtracting the present value of the dividends from it, and take that as an updated stock price and do all the relationships in a similar manner. So these are some of the things which I hope you should be comfortable with when we are dealing with the various properties of stock options. In case you have any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.